Good morning, ladies and gentlemen, valued stakeholders, key clients, EXCO, and Old Mutual colleagues. On behalf of Old Mutual, we would like to welcome you to the official launch of our core growth portfolio product. This has been in the works for some time, and today we are proud to announce that it has finally arrived. My name is Isaac Vey. I'm the National Sales Manager of Corporate Segment Namibia.
And I'm Paul Gordon Wap. I'm the Head of Distribution for the Corporate Segment. We will be your MCs for the day. Thank you for taking time from your busy schedule to join us for the official launch of the Core Growth Portfolio here in Namibia. The Core Growth Portfolio was officially launched in March 1998 in South Africa and have over the years each its way into the corporate to moderate low portfolio space as a smooth bonus portfolio. The smooth bonus portfolios have always been Old Mutual's long-term strategy for conservative investors, and the core growth portfolio of today is actually a complementary product to the already existing absolute stable growth portfolio. Of note, however, is that the core growth portfolio has lower investment and capital charges.
In line with expanding the range of our smooth bonus funds, Core Growth Portfolio would serve clients well alongside AGP in terms that it is a conservative fund that is targeted at medium to long-term investors. This will ideally cater for clients that seek a capital protection option. COVID-19, the dreaded COVID-19, what has it taught us? One thing it has taught us is that certainty or uncertainty is a certainty. This global pandemic has impacted our daily lives, investments, and savings. What we saw last year was a negative decline in financial markets at the end of Q1, start of Q2 in 2020, where subsequent to that we've seen strong market recovery up until this point where we are now.
Yes. From the generally good market returns we have experienced over the past year and a half, we can't but anticipate a decline. The question is probably not of if, but rather of when.
When it's going to happen is a very good question indeed. Hopefully our experts today are going to shed some more light on the subject, and we would welcome them to bring some quite insightful tips for us on how we can navigate and approach this COVID-19 pandemic and the investment landscape.
Great. Our program today starts with Ms. Patty Olivier, the head or the executive of the corporate segment, followed by the Old Mutual Group CEO, Mr. Tertius Shigariro, who will then give us a keynote address.
Followed by that, we'd have an economist who's going to give us a good view and lay of the land, followed by our product expert who's going to give you a breakdown of this core growth portfolio product that we've been waiting on for some time.
Ladies and gentlemen, Ms. Patty Olivier with the opening remarks.
Sure. Thank you, Directors of Ceremonies. Ladies and gentlemen, a very warm welcome from me. I really appreciate you coming. And before I start, let me acknowledge our Group CEO, Tertius Shigariro, who is in the audience with us here today and who will also deliver our keynote address, as Paul has said. Executive of Old Mutual, who is listening to us virtually. Senior management of our corporate business, staff of corporate segment, prospective customers, current customers. Ladies and gentlemen, I really want to welcome you to the session today. I appreciate the time that you've taken to attend the session to hear what we have on offer for you today. I am very excited about the new investment product that we are bringing to market, and I'm sure you will be too once you hear what it's all about. Corporate segment, or better known as employee benefits within and outside of Old Mutual, has always been a partner to many businesses, employers, and employees. I almost want to take the liberty to say that corporate segment has been for a long time in a spousal relationship with employers, where together we provide for employees in times of death, disability, and ultimately for retirement to enjoy life beyond their formal work life. The latest edition of our product range to be launched today will most definitely cater for employees closer to retirement who want to ensure that their assets grow appropriately whilst protecting it against adverse market conditions. This will certainly give employers peace of mind, knowing that they have done their best to secure retirement saving for their employees once they are done with formal work. This business will never be able to be a strategic partner to all the employers that we're currently working with without the dedication and hard work of our staff. And therefore, I would like to take this opportunity to quickly introduce the senior leadership who've recently joined the corporate segment. I'll start with Carmen Foster. She's actually, I don't know whether the cameras can probably turn to Carmen so that those online can just see Carmen. Carmen is sitting next to Tashius. Carmen is an actuary by profession, and she joined corporate team as head of product development and client retention. So we're looking forward to a very good product development in the corporate space. The consulting team will also report to Carmen, and she joined us on the 1st of April this year from the Old Mutual Actuarial Department. But she's been an old hand in Old Mutual. She's been in Old Mutual for 13 years, and she actually knows the business quite well because she's done a lot of valuation for corporate business, and she knows the industry as well because she's also worked for Alexander Forbes. Where else, Carmen? Namibia Asset Management as well, so she's an old hand. So we're looking forward for good things to happen with Carmen in our space. Welcome, Carmen. And then it's Paul Gordon Wedi Wap. I've really tried to do the click sound, ladies and gentlemen. I haven't succeeded, but I promise you next year, this time, when we give you an overview of how Core Growth has done, I will have mastered the surname of Paul. Paul is an accountant by profession. He joined us on the 1st of June as head of distribution, and he's also one of our directors of ceremonies today. Paul came from Retirement Fund Solutions, where he successfully operated in various senior roles. He was until recently a board member of Riffin, and he will undeniably, my apologies, sometimes the nerves get the better of you, but that is part of being human. We undeniably managed to secure a seasoned pension fund resource in our midst, and we're really looking forward to doing great things with Paul. Welcome, Paul. And then Isaac Vey, who's also an accountant by profession. He joined our team on the 1st of May as National Sales Manager from the Old Mutual Wealth business, where he operated in at various senior levels, and he's also an old hand in Old Mutual, and he's already putting everything together to see all the good clients and all the prospective clients to do good sales. And ladies and gentlemen, that's why the two of them are so serious. They can't wait for us to finish this launch so that they can go out there and talk to you guys who are listening to us. So we're really looking forward to good engagement with our clients or prospective clients. These three new additions to the team come with a wealth of experience, as I've just said, and will most certainly strengthen the arms of our senior management that we already have, who's Joran Martin, our Quality Assurance Officer, and Eben Basson, our Operations Manager, to deliver results as best as we can to our customers. I trust that you will really enjoy the rest of the sessions, and please sit back, relax, grab a coffee, and listen carefully to what we have to offer to you. Thank you very much, and God bless.
Thank you very much, Patty, for those welcoming remarks. Next up, we have our Group CEO for Old Mutual Namibia. Just to give you a brief background, he has joined us as of the 1st of January this year. However, he's not a newbie by any means to the Old Mutual Group. He started his career with Old Mutual Zimbabwe as an actuarial analyst, whereby those accolades took him to the UK, where he subsequently returned back to South Africa in the Old Mutual Investment Group, where for 8 years. After that, he held the position as the managing director of the Old Mutual Life Company in Zimbabwe, which for 4 years, which has eventually brought him to this day to join us here at Old Mutual Namibia. He is a fellow of the Actuarial Society of South Africa, and he is a chartered financial analyst. Without further ado, ladies and gentlemen, we would like to present to you the Old Mutual Namibia Group CEO, Mr. Tertius Chigariro.
Good morning, colleagues. Morning. And good morning, everyone online. And good to have you this morning. And let me first by acknowledging the Managing Director for our corporate business. Patty, thank you very much. And your team, and your great team that's been introduced before me today. And we're looking forward to your serving of our wonderful customers over the next few years in a distinguishing way. And let me also acknowledge the chairmen of retirement boards that are joining us online today, the principal officers, the board of trustees, employers that are joining us today online, and members of pension funds, of retirement funds, and all our valued customers. We thank you this morning for joining us. I need not pause to say how delighted I am this morning. I'm very excited by the product we are going to launch today. The product has been designed with customers in mind, and that is very important. Customers want to feel that they are cared for. They want to feel that in an authentic way. Being authentic cannot be faked. Our products must reflect the care for our customers. As the CEO of Old Mutual, my desire is to put the interest of the customers ahead of those of the organization. Doing this is good for the sustainability of the company. We must be prepared to deliver excellent products and excellent service to all our customers, be it corporates, individuals, big or small. When Larry Page took over as the CEO of Google in 2011, he said something remarkable to me. My primary goal is for Google to be a big company. That is the nimbleness, the soul, the passion, the speed of a startup. And I share the same desire as Larry Page. Old Mutual was launched in 1845 at the Cape of Good Hope in South Africa. It was launched under the name Mutual Life Assurance Society. The mutual in our name meant a common relationship, a common partnership with our clients. It is said back then, more insurance companies started coming onto the scene, claiming to be mutual societies. Customers could no longer distinguish which company was which. They wanted the original, genuine one. They wanted us to explain which one, the one that was approaching them. They wanted the original one, the old one, the one they knew and the one they trusted. And we became known by our customers as the Old Mutual. We were their preferred choice. 176 years later, we remain the preferred choice for our customers. Our founding fathers didn't just leave us with the original mutual society. They left us with a motto, coined it at the time of the launch in 1845. That is, a certain friend in uncertain times. One thing guaranteed in life, as said earlier, it is part uncertainty is guaranteed. It is part and parcel of the beauty of humanity. That is why we bring products that are suitable for life's uncertainties. From the cover of your precious assets, valued assets, your home, your vehicles, to the cover of most important asset, which is your life and your loved ones, to the protection of your hard-earned investments through a variety of products with guarantees. Our logo in itself symbolizes 3 anchors, a sign of stability against strong winds. When you partner with us, you know when trouble comes, there is a certain friend in uncertain times. We understand that partnership needs to be nurtured. J.F. Kennedy once famously said, partnership is not a posture, it is a process, a continuous process that goes stronger each year as we devote to mutual tasks. At Old Mutual, we desire to continuously improve our partnership with our clients, which has driven us to be launching the product we are launching today. That is the reason why our organization is the giant it is today. It is our customers that continuously support us. Today, the world is in turmoil because of a microscopic virus threatening humanity. The virus has disrupted our lives and livelihoods. Our business is experiencing a time of settling several death claims, far greater than we ever anticipated. We are seeing people being retrenched and having to claim their retirement benefits way sooner than they ever planned. We remain anchored to the guiding philosophy left by our forefathers, to be your certain friend in an uncertain environment. Old Mutual is committed to Namibia and its citizens. Old Mutual is not a visitor in Namibia. It has been operating in this land of the brave for more than a century, and has been tried and tested and proved to be resilient. Old Mutual has positioned itself to live longer than your grandchildren. Old Mutual supports the country with fighting the pandemic and has donated several million Namibian dollars last year, which saved many lives through the COVID relief program. This year, we have played a key role in supporting the vaccination program. While we absolutely respect the choices of those that are not ready to be vaccinated, it is our desire to save Namibian lives. Today, we are launching one of our special products, the Core Growth, designed for your retirement savings. In our country, we see ourselves as the best financial services company where you can meet all your needs, including building your wealth. The Core Growth portfolio, that is a good combination of investment growth and protection. A lot of people say, we do not need protection. We do not need cover. We do not need guarantees until they are a victim. Trading markets have started centuries ago. It used to be believed that a big market crash happens only once in 50 years or 100 years. Most of you of middle age, like me, have witnessed 5 such big crashes in under 50 years. The Black Monday of 1987, the dot-com bubble of 2000, the credit crisis of 2008, the coronavirus crash of 2020. Who knows when the next one is? We can only wish it is not going to be in the year when you have to retire. If you are not in the Core Growth portfolio, that is. Let me end by saying to our customers, you cannot judge the quality of a crew when the seas are calm. And let me extend that to say, You cannot judge the quality of a company, a good company, in good times. And let me finalize by saying, Old Mutual has been tested several times and will be there when you need it. At Old Mutual, we say, do great things every day. Wherever you are, may I challenge you to do great things every day. And it starts by making great decisions. Ladies and gentlemen, thank you for listening to me, and I hand over to the rest of the program and enjoy this launch of our fantastic product called the Core Growth. And we thank you for partnering with Old Mutual, and I look forward to further partnering with yourselves into the next years to come. Thank you very much.
Thank you, sir. Mr. Brown will now take us through the economic outlook. He is one of Namibia's best-known economists. He is a regular in the Namibian and regional print, broadcast, and media. He has worked with and presented to most of the large corporates in the country and key financial ministries, offices, and agencies, and have provided advice to ministers and senior level advisors. Over the recent years, Mr. Brown has worked on the continent, focusing on financial economics and investments. Since 2014, however, he has been a technical expert to the International Monetary Fund. Please welcome Mr. Brown.
Thank you very much, gentlemen, and good morning, everyone. I'm going to give you a brief presentation on the state of global markets and the economy, and a little bit of what to expect going forward. As well as being the least well-dressed here today, I'm also the least positive, I'm afraid, and that seems to be a mark that has traveled with me the last few years, perhaps for good reason. I'm going to start my presentation by giving you a brief history lesson, but very brief. As you'll remember, 2019 was a time of unicorns, rainbows, flowers, butterflies, and everything was going relatively well in the world. We had reasonable growth. Global economy was growing pretty well. Unemployment levels across much of the world were very low. And in the US, for example, some of the lowest unemployment levels in a very long time. Then 2020 came along. And as you will recall, this time just over a year ago, the world changed, and changed very, very suddenly. And we went from that period of relative growth, relative prosperity, low levels of unemployment, to a very different space pretty much overnight. From markets performing well, from unemployment at very low levels, jobs being created in the US at a remarkable rate and similar, we suddenly saw the economies of many parts of the world grinding to a relatively abrupt halt as lockdowns were introduced, as restrictive measures were introduced to try to contain the spread of this virus that we all now know so well. And with that, those measures to contain the spread of the virus, we also ended up putting a lot of economies under very severe pressure, including our own, and Namibia has certainly not been the worst affected by this. And in essence, we had this situation. The fire was raging around us a little bit, and we had a very difficult situation to manage. For those of us involved in financial markets and the macroeconomic events that drive those financial markets, it was an interesting but a very terrifying period, and I think probably remains that way to some extent. The global stock indices fell very aggressively, as you can see towards the end of this chart, from sort of January 2020 through to March. We had one of the fastest bear markets, the fastest 20% declines in the stock market that we've ever had. Indeed, I think the fastest. And you can see on the global indices this very, very abrupt adjustment from well-performing to collapsing markets. And we didn't really know exactly what was going to happen. At the time, this correction was due to the fact that shops were closing left, right, and center in the US, where you have a lot of at-will employment. unemployment was picking up very rapidly, and there wasn't yet a clear indication of what was going to happen, what was going to be the policy response, what was going to be the extent of this virus's impact on the world. And in our region, in Southern Africa and in South Africa, the big brother of Namibia, we saw exactly the same. This very rapid adjustment in our stock markets. And if you look at late March last year, just over a year ago, our markets were down, in excess of 20%, well in excess of 20%. The implication of this was that uncertainty, which, as you've heard, is very much the theme of this morning, but very much the theme of life as well, was at an incredible peak, something that we haven't experienced in a very long time, and we certainly haven't seen a virus like this for the best part of 100 years. And certainly this uncertainty could be seen very clearly in these markets, and by extension, the wealth and savings of very many people, including most Namibians. We then saw a huge change of global risk profile, as you'd expect. As markets were tumbling, we started to see this classic risk-off move with lots of money flowing out of emerging markets, lots of money flowing out of high-risk assets into low-risk assets, such as US government debt particularly. And as a result of this huge demand for those assets, that US government debt, the yields on those instruments collapsed, as you can see here towards the end of this chart, where the US 10-year and the US 2-year came very close to one another, and you had a pretty much flat US yield curve. Commodity prices also tumbled, and this had a big impact on many of the goods that the region produces, many of the core exports that we have. Gold prices, however, did rally, and this was obviously positive for ourselves and for South Africa. But generally across the world, we were in a period of incredibly abrupt change from a relatively predictable, steady state to a very, very different world and a huge amount of uncertainty and nobody knowing exactly where it was going to go. And after this sort of slight delay and period of uncertainty, we suddenly saw huge responses from most of the developed world and most of the emerging world as well. One sign of this was the resumption of quantitative easing in the US, a QE sort of 5, as it were. I don't think ever officially named such, but similar. Huge amounts of liquidity being injected into the US system, incredibly low interest rates, the central bank purchasing huge amounts of asset-backed securities, generally US government debt. And the same across Europe, the same across many of the bigger emerging market economies as well. And then at the same time that we had this huge monetary stimulus, we started to see huge fiscal stimulus, so governments starting to spend aggressively, and the US, I think for the first time in history, certainly the first time that me and my team could find, actually giving cash to the populace in order to try and stimulate economic activity once again. So we use the word unprecedented far too often, but certainly when it came to the monetary and fiscal response that we saw to this virus across the world over the last year, it has been unprecedented. And by nature, that creates a huge amount more uncertainty because we haven't seen the result of this sort of behavior before in full. And so going forward, the uncertainty is certainly not out of the system. However, for our region, there are some promising signs starting to develop. And the first one, I think, is, and I see the title on this chart is wrong, but it should be the US dollar rand exchange rate. But what you can see here is that after that big blowout that we had towards the end of last year, which even exceeded the weekend special finance minister blowout of late 2015 in the rand, we've seen rand strength starting to come back, and we're back at 13.50. Our institution released in late April last year, a piece of research where we suggested that within a year the rand would be back below 15. And within 2 years would be at about 12.50 and possibly slightly stronger. We were laughed out of many boardrooms, but I think we're quite comfortable to stand by that prediction, and we believe that this rand strength will continue, and that is perhaps one positive sign for our region. But still, there's a great deal of uncertainty that surrounds this. Now, the big reason for this is because of this huge amount of global money printing that we've experienced over the last few months or the last year or so, but also because of the fact that commodity prices have suddenly rebounded as many economies such as China, India, and others have sort of tried to move into stimulative measures or tried to embrace stimulative measures that will help to revive growth in those economies, which include a lot of construction and infrastructure type projects that require commodities. So that's been very good for our region. But as well as that, we've seen huge injections of money into the global system. And this money printing is resulting in a lot of money now finding its way out of those advanced economies and starting to flow across the world into other economies, and particularly into the likes of South Africa, one of the liquid emerging market economies where you can still get good returns, good yields, and similar. And so you can see from this chart, after this aggressive sell-off until about January 2021 by foreigners of South African equity and South African debt, this rolling 6-month trend has now turned, and it looks as if the flows are starting to come back into South Africa now. And this is exactly what we predicted in our piece of April 2020, where we said once things start to stabilize and you get a bit more of a risk-on move, South Africa is a very attractive jurisdiction in which to invest, considering that you get good real yields there. And we think that that's now starting to play out. And while we see this rand strength taking place at the moment or coming through at the moment, we think it's got a lot more legs than we initially anticipated. And we believe that our previous forecast of around 1250 may actually be quite ambitious or quite conservative, let's say. This big inflow of funds into emerging markets and this flow that we've seen over the last few months has certainly helped when it comes to the cost of borrowing for the likes of our government. And you can see on the Namibian yield curve here, the greenish line on your charts is the most recent yield, so the return that you get as a borrower. But it's also what government pays on the marginal bond issued, the marginal debt issued. And you can see the shorter end of the curve up until about 2023, borrowing up until 2023, so just under 10 years. It's become cheaper for government to borrow, not as great for those wishing to save at the moment on that shorter end, but certainly a positive sign when it comes to government's ability to drive some stimulus, some additional spending, some marginal spending. On the longer end of the curve, I think across the world what we're seeing is the risk of fiscal stability decreasing, or the risk increasing, the fiscal sustainability decreasing, and the same is true in Namibia. The quantum of this shock and the impact that that's had on the fiscuses of Namibia, but also many other countries in the world, is very substantial, and that does obviously increase the risk as you go further out along the curve. But I think in this vein, it's very important to bear in mind where Namibia was prior to COVID. And while it was rainbows and unicorns and flowers and similar for much of the rest of the world, Namibia has been struggling for a while. And this is something that we're very cognizant of when it comes to asset allocation and similar going forward. In 2019, Namibia was the 16th slowest growing economy in the world. So we had a number of problems prior to COVID coming along. And I'll speak through these in a little bit of detail. At the same time, a large portion of the reason that we weren't growing was because we didn't have strong investment flows into the country. And this then manifested in exports, jobs, revenue for government, and similar. And when we look at the impact of COVID-19, we have to keep that backdrop in mind, because it is of a great deal of importance. So COVID came along on a weak backdrop, and it added 3 additional shocks to the system. The first shock was the shock from an external demand perspective, foreigners, particularly in the tourism industry, not being able to come to Namibia, not being able to purchase Namibian goods and services in the manner that they did previously. Secondly, production shocks domestically. This was largely due to the lockdown last year, and as we see cases rising now, we do scratch our heads and wonder if we may not see more aggressive measures introduced this year, which could once again provide another domestic production shock. And then the third impact, and the one that I believe most relevant to this forum and this product, is the shock on households. The fact that many households did experience losses or reductions in income over the last year and may continue to experience those losses or further losses going forward. We believe that this will now reverberate through time a little bit, because those households with less income are less able to spend than they when compared to a year or a year and a half ago, and that will reverberate through the economy and second round effects going forward. And we think that that's very important when it comes to planning going forward. But if we very quickly look at the three components of the Namibian economy, households in Namibia are under a lot of pressure. We do have very high levels of debt relative to household incomes, and with household incomes falling and debt levels not, obviously this ratio of household debt relative to household incomes deteriorates further. And this is something we should all be concerned about. At the same time, we do still think that both wholesale and retail trades, so people working in the industries in which these households spend money, the households that have suffered losses or reductions in income, in which these households spend money, are still relatively vulnerable, because we have not yet reached some form of steady state where we know what the long-term impact will be. So many of the wholesale and retail outlets are likely to be clinging on to see what becomes the norm before making big decisions around staffing and similar. And then, of course, the tourism industry as well, proxied here with accommodation and food services. The initial expectation, I think, around tourism was that the rebound would be relatively rapid. And one of the arguments we had about 14 months ago was an argument with a certain minister who believed that we would see a V-shaped recovery in the tourism industry, and we struggled to see how that would be the case. But it certainly seems that much of the industry has assumed this to be true, that we will see some sort of V-shaped recovery, and that's looking less and less likely. And so we believe that there remain a large number of vulnerable households linked to that industry. We can see this manifesting in the numbers now, but I think importantly you can see in this chart that this big upswing in overdue loans, up to close to 12 billion worth of overdue loans from the Namibian private sector to the banking sector, started well before COVID hit, and COVID just exacerbated what was already a pretty fragile situation. So households remain under very severe pressure with weak balance sheets and not likely to be driving growth for a while, and that obviously is an area of a great deal of uncertainty and a great deal of risk, for which I'm sure Old Mutual has at least one product. From a government perspective, the situation is also pretty fragile, and you can see here the gap between revenue on the bottom line and expenditure. And this gap that has the jaws in this picture having widened over the recent years, and the bars at the bottom being the borrowing requirement each year. And we can see that now for a number of years, government's been borrowing aggressively. And even though the marginal cost of borrowing has perhaps come down, this does put us in a situation where we've seen rapid growth in government debt, and that makes for a huge amount of uncertainty once again. So if we go back to 2010, Namibia had, between independence and 2010, accumulated a total of about 13 billion worth of debt. Just 1 year later, by 2011, this had doubled. 4 years thereafter, by 2015, it had roughly doubled again. And now, at the end of 2020, roughly doubled once more. So at least the rate of doubling, the time it's taken to double, is decreasing, so that's obviously, increasing, so that's obviously a good sign. It's not becoming exponential, but certainly the growth of debt is something that is concerning, and the long-term outlook with regards to this and how we get this problem under control introduces a great deal of uncertainty. Over the forecast period for finance, there's an expectation that we'll see another roughly 50% increase in our debt levels over the next 3 years. And thereafter, it's not yet clear exactly what's going to happen. So once again, a great deal of uncertainty. The implication of this is that there's a huge amount of borrowing from savers that takes place. and government is borrowing now roughly 1.5 billion per month, which is certainly a lot higher than we've ever seen before. And this is something that we believe one needs to keep an eye on. And government sits with a very difficult situation, which creates a huge amount of uncertainty. So continue the status quo, in which case we'll end up with unsustainable levels of debt pretty quickly, or try and do something on the expenditure side of the budget because of the fact that we don't really have a growing economy and we're not expected to see very strong growth over the near term, limits our options with regards to revenue. So this puts us in a very tricky situation. How do we reduce expenditure without causing a further slowdown in economic activity, without driving increases in retrenchments from government because of the fact that much of the rest of the fat within the budget has already been removed over the last 5 years, and really the only thing that's been untouched is the wage bill. And obviously the extension of that is social unrest. So once again, vast amounts of uncertainty in terms of what happens going forward. For businesses, I've just shown one slide. I don't think it's wildly relevant here, but I think my colleagues like putting slides like this into my presentations, and I think there may be some merit in showing this. But I'll skip past it. And in conclusion, I think the key thing when it comes to this theme of uncertainty at the moment really still revolves around COVID, but also the long-term impact that COVID will have on both our country, our people, and the world at large. And you can see here that this big ramp up with regards to COVID cases over the last few months has taken us past the initial peak, past the second peak, and it doesn't yet look as if we're close to peaking when it comes to this particular outbreak either as we move into winter. And this means a huge amount of uncertainty for the macroeconomy, a huge amount of uncertainty for household incomes, for livelihoods, and a huge amount of uncertainty over the long term as to the breadth, depth, length of damage that this virus will do to what was already quite a vulnerable economy with vulnerable households, one of the highest youth unemployment rates in the world and similar. And because of this, it's difficult to predict the future. As hard as it is generally to predict the future, COVID has certainly made it more difficult to do so. But what we can see in the high frequency indicators that we follow is that we are still a long way away from normal. And I was given a brief that I must be quick, so I've just shown one slide here with regards to high frequency indicators, and this shows tourism arrivals. If you just think back to the slide where I mentioned vulnerable groups, one thing that you may, or groups vulnerable to loss of household income, one thing that you may have noticed is that the tourism industry is one of the largest employers in the country. So if one of the largest employers in the country is far from normalizing yet, it's also one of the few employers that pays cash wages into rural areas with high multiplier effects. So if you consider that that industry is still a long way from normalization, you must see that the impact on the broader economy as a whole will remain, and will remain for some time yet. Nevertheless, after giving negative presentation, we do expect to see growth this year. In 2021, we are expecting to see growth of about 3.8%, but this is largely due to the fact that we're coming off an extremely low base last year. So we lost roughly 10% of last year, 5 weeks of lockdown, for the likes of beverage production. We lost most of last year when it came to tourism activity and similar. And with some degree of normalization through this year, which is our base case, we do expect to see some recovery. But if you look at the bars that you can see vague or light in the background there, you'll see that that recovery doesn't take us back to 2019 levels. And you'll also see that 2019 levels were already quite a long way off 2015 levels. More than that, we've had a growing population over this entire period. So the implication of this from a income per person in the country, or GDP per person in the country, is more severe yet. And our forecasts, or the maths around this, shows quite clearly that in order for Namibia to return from a GDP per capita perspective to where it was in 2015, we need compounded growth of 4% per year over the next decade, just to get back to where we were in 2015. So certainly there's an uphill challenge that lies ahead. Nevertheless, as it comes, or as we look forward into a post-COVID recovery, there are certainly some positive signs, but also certainly some challenging signs. Global recovery has been slower than was initially expected. And while I mentioned our debate with the minister, the IMF too was claiming that there would be a V-shaped recovery in the global economy. So while we saw a V-shaped recovery in financial markets, we didn't see a V-shaped recovery in the global economy. And while we've picked up from the base or from the low point of March last year, we certainly aren't back where we were before when it comes to economic output around the world. So the recovery globally is proving to be slower than expected, although the vaccine rollouts, the vaccine availability was much faster than many experts predicted, so some positive and some negative. The financial markets, however, have rebounded much more aggressively than economic recovery, and this has very much been driven by that stimulus that I mentioned previously, a lot more money chasing the same pool of global assets, more or less, driving up asset prices. But we are seeing some structural improvements taking place now around the world. So we are in particularly countries where they've got closer to herd immunity via vaccinations or cases or whichever, and where you see economic activity normalizing, we are starting to see some recovery. So we do know that long term, we should rebuild to where we were previously. This is not a time-ending virus, hopefully. From our region's perspective, we are seeing inflows back into our region, and this is something that's very positive when it comes to the likes of borrowing for governments, hopefully borrowing for corporates, borrowing for households to rekindle growth within our regional economies. And this is largely due to this risk-on profile that we're starting to see much of the world take as your more developed economies get close to herd immunity and this sort of dam wall breaks with regards to the risk profile of most investors. The downside here as well, however, is that this money printing, as the velocity of circulation of money starts to pick up again, the quantum of money available with that increased velocity of circulation of money will mean that there's a huge amount more money in the system. And this is likely to drive inflation. Whether that's inflation at household level or inflation in asset prices remains to be seen, but in all likelihood, a combination of the two. So we do expect to see inflation coming through in advanced economies over the next year or so, and we also expect that that will ultimately filter through into our part of the world, while the strong exchange rate will help to offset it to some degree. The local situation is still very precarious, and we don't think that this is a story that will disappear overnight, but hopefully a story that will disappear with time. And this is largely because many of the pre-COVID issues that we sat with remain largely unresolved. Many of those structural issues we had and the structural reform needed have yet to be introduced or implemented. We have gone into this shock with relatively vulnerable households. On average, obviously there's a spectrum, but relatively vulnerable households on average, very high levels of unemployment, 33.4% unemployment, very, very high levels of youth unemployment. But these households, the spark to rejuvenate household incomes, which is ultimately how you repair household balance sheets, is yet to be seen, and hopefully not too far away. But hopefully this global rising tide will help to lift our little economy's boat, and that perhaps will be one of the positive signs to look for over the next few months. The improved commodity outlook that I mentioned previously is certainly something that is worth keeping an eye on and will help us when it comes to hard currency earnings, even though we do have the loss of tourism income, which historically was a very important source of hard currency earnings. But we are seeing some offset to that, so it's perhaps not all bad news there. And then the big question is, are we yet getting close to a macroeconomic turning point, both from a pre-COVID perspective and from a COVID perspective? And we think that the answer to that question now is more leaning towards yes than has been the case for probably 4 or 5 years. When we presented in 2015 and 16 and we were asked what our long-term view is, we said we think that there's a lot of pain ahead. Now we think we may be getting closer to a bottom and to a turning point. But it can take time. These things always take longer than you expect. When it comes to the risks around this outlook, however, they are plentiful. And that very much, once again, speaks to this theme of uncertainty. COVID cases are on the rise again, as mentioned, and it's clear that the recovery will be prolonged. We won't see this sudden bounce back, and I think while the recovery will take place, it's not going to be a quick recovery. It'll be a number of years to get back to where we were, for example, from a tourism industry perspective, a government revenue perspective, and similar. The macro and fiscal damage globally has been severe, and of course Namibia hasn't been spared of this. The one point that we do like to make, and that we themed our 2020 outlook, was that we felt winter was coming, and we said the hay barn is empty. And I think that there's a very important lesson in this, to make hay while the sun shines. And while it was rainbows and unicorns and similar in 2019, Namibia was not making hay, and we need to learn from that. The big question mark as well is around the policy response, and do we get the policy environment right now in order to attract the investment we need in order to rekindle growth, rekindle productive activity, rekindle job creation, and rekindle revenue growth for government. And if we do get that policy environment right, Namibia is such a small drop in the ocean of the global economy that with relatively minimal investment, we can see a grand resurgence of this economy very quickly. And I think that policy response is the key thing to look for. And then from an investor perspective, a great risk, of course, from a saver's perspective, a great risk, of course, is the fact that we are, from a fixed income especially perspective, in a relatively low return environment for the marginal dollar deployed. Should you have had funds invested in fixed income over the last few years, or last year, you've probably done extremely well, but going forward, the marginal dollar deployed is not yielding you the return that it did previously. And with inflation coming, that is certainly a risk that we must keep in the back of our minds and plan for. And I think I can leave it at that. I hope I've not gone over my time, but thank you for listening to me this morning. Thank you.
Thank you, Roland, for that economic update and overview. I think that is quite insightful and very much in line with our theme, that is around uncertainty and us being your uncertain friend in uncertain times. In preparation, this sets up the scene well for the next speaker, who would be Fred, who is our head of Group Retirement and Guaranteed Solutions. Fred has been the product owner of the largest smooth bonus fund in the South African market for almost the last part of the 10 years, which that fund essentially accounts for 80% of that market share in South Africa. He has partnered with our Namibian colleagues to develop this product for Namibia, and we obviously hope that this is going to, or not hope, but we know this is going to go well, and this is essentially what the market needs, is to provide certainty and assurance in these uncertain times. And without further ado, we would like to present Fred van der Vyver. He is an actuary by profession, and smooth bonus funds is what he does. Thank you very much.
Thank you very, very much, ladies and gentlemen. I'm here from Cape Town, and that my screen is active now. Isaac, can you maybe just tell me if everything is ready to go?
Can't see you yet. Okay, there you are, Fred.
There we go. All right.
Brilliant.
So thank you very, very much, Roland, for that introduction. Wow, that is certainly some doom and gloom. And I hope I can share some positive news with you. I'm certainly excited. But before I start, I guess if you are the worst dressed person in the room, and my brother Tashius is certainly the best dressed in the room, I hope I come in somewhere in between. So I'm greeting you from Cape Town. It's really lovely for me to join you. And before I start with my presentation, maybe I'll just say that the marketing police of Namibia have been really saying that I should definitely, whatever I do, I should stick to the marketing template of the slide pack with these beautiful umbrellas. And I guess the only point about that is that it's only in Namibia where you can get a picture like this, because in Cape Town, the wind would just blow it away and all we're left with is a mountain backdrop. But into the more serious matters of the presentation today, I have some really great news to share with you in terms of the latest product that we've developed. I guess any normal presentation would typically start off with a typical agenda where we look at, what are the things we want to discuss, and I want to take a different approach today. So what I would like to discuss with us today is firstly just start off and look at the world around us. Now, Roland, from an economic perspective, gave you a real good overview of the world around us in terms of economy. And the benefit of economy is it all makes sense. You can explain things. You can explain why the job numbers are down. You can explain why GDP growth is what it is. And a lot of it's got to do with the pandemic at the moment. What I want to talk about is the world in which we actually need to earn our returns, which is investment markets. And unlike the economics, investment markets don't always make sense. Who would have thought that global equities would have returned about 20% positive return over the 12 months since March last year? We were right at the bottom of the worst type of situation we could have had. I see a comment here that says, I cannot see the presentation. Is it just a few people, or can you see the presentation on your side?
We can see you, Fred, with the globe.
There should be.
Yeah.
Yeah, great. Okay, so maybe it's just the one person that said he can't see it. So yeah, hopefully he'll catch up soon. So what I want to share with us is just looking at investment markets in perspective. And when I say in perspective, I like to just for the moment zoom out from the current crisis and look at the world from an investment perspective over a slightly longer term. I will then move on to look at some international trends, because I think that's very relevant too. Because given the world of investments that we're in and the way that markets operate, there are some clear trends in international terms around how people are rethinking investment for retirement and some of the interesting things that are coming out there. Following that, I will, of course, obviously talk about Old Mutual. And now the marketing police will really nail me because that logo of Old Mutual doesn't fit our corporate color brands. But the reality is I've got a black pen. And the rest of my presentation, I'll really focus on the big reveal and the big launch of our latest core growth investment product. So I really hope you're going to enjoy it. And in about 20 or 30 minutes time, I will be done. And then we can move on to some questions and answers. All right. So what we've got and what I would like to start off with is just a view of the world over a longer term. It is so easy in the current environment to really get caught up in what has happened over the last year and to lose perspective. And so our investment group here in South Africa, but I think the studies are more generic and international, so it looks at asset classes around the world, so it's equally relevant for Namibia. But they do some great research work every year where they look at very long-term returns. And if I say very long-term, I literally mean they go back for 91 years. So they almost go back to the Great Depression. And it is when you take a step back and you zoom out and you look at investment returns over such a long term that you really get perspective. And it is from that perspective that we design our portfolios to then deliver on our long-term goals. So the first slide I want to show you, I don't expect you to be able to read. I don't expect you to be able to make sense of this. All I want you to see on this graph is the colors. And so the colors that I want to highlight, each of those colors represent a different asset class. And in terms of the table, it shows you the best and the worst performing asset class over each calendar year over the last 10 years. And the point I want to highlight is that this is a crazy world to try and find your returns in. If you look at gold as an asset class, for example, it was the best performing asset class in 2011. 2 years later, it was the absolute worst performing asset class, and back up to the best performing asset class almost in 2018 and 19, and the best in 2020. Similarly, if we look at global equities, we find that global equities were the best performing asset class in 2013, Then it was almost the worst in 2016, and again up to the best performing asset class in 2019. And so if I look at this slide, I'm reminded about my time with Tashias before he became a famous CEO of African investment companies. He was down in Cape Town with me as well, where we tried to navigate this world and we tried to manage the risk attached to this world. And I know there's a saying that says fortune favors the brave, but I'm afraid in today's investment markets, it's more a matter of survival. We all need real returns, and it's not just a matter of fortune favors the brave, but more about survival favors the brave. So you really need to be brave in this world. You need to take risk, otherwise you are going to completely lose out. It is not difficult to see that cash has been some of the worst performing asset classes on this slide, but the reality is we need to navigate this world. But looking at these things over a short term, over a slice at a time, 1 year at a time, it's really easy to get so scared and not have the longer term perspective. So what I want to show you in a moment is that this is a similar picture of some of the Namibian asset classes. And we throw in some South African asset classes there as well. But clearly you can see that despite all the doom and the gloom of the last year, global equities delivered 22.10 or 1% over the last 1 year. But we all know as well all the risks that we faced. And so in the South African listed real estate sector, it was really blood in the streets. But also from a Namibian equity perspective, your equity market is still down 10% from March last year, which is not great news. So it's very easy to look at this also and become very disheartened around how do one navigate this world? How do you start constructing investment portfolios, and then how do you deal with the consequent risk attached to it? So I want to come back to the long-term perspectives research and report that we do. And what you will see here on the table to the right is something that makes a bit more sense to me. This just looks at nominal returns of different asset classes, and I immediately apologize, most of these are South African based, except there are global equities as well, but I think there are very similar trends. And the point I want to highlight is if we look at the very first column, that is the blood in the streets type of column. That shows the poor returns of different asset classes and the significant variability. But if you cast your eye to the right in the blue section of the table, that now starts to look at the annualized returns over longer periods of time, starting with 5 years, going all the way through to 50 years, the second last column, and then ultimately over 91 years. And something clearly emerges. The one thing, it becomes more stable, which is a good thing. But the thing that is most pronounced for me is the fact that the real growth over the very long term comes from equities and growth assets in general. So you can add to that private equity, you can add to that properties or alternative investments, but really riskier growth assets. That's where our real returns come from over the long term. And so I want to just emphasize this to some extent, because it is so easy in the world that we're in at the moment that we become so scared about the risks out there that we end up investing too conservatively. And it's so easy close to retirement, say I've got 2, 3 or 5 years out to retirement, I just want to preserve my savings and I go into cash or very short dated bond instruments. And doing that, of course, is going to not allow you to capitalize on the growth that do come through in bursts from the growth side of the economy. So today is all about sharing how do we construct portfolios that leverages this long-term feature that is embedded in investment markets without exposing our investors to all the risks attached to it. So I'm going to be speaking a lot about investment management today. Of course, if we look at similarly, just in real terms, after taking out inflation, it's a very similar picture that emerges. So even after taking out inflation, the asset class that delivers the most real returns are also the asset classes that present the most risk in the short term. So before I go to our portfolios, I thought it's useful just to make a few comments around what I'm going to be sharing with you today. So a lot of what I'm going to be sharing with you today is about, leveraging the power of the collective. Sharing investment risk in a bigger portfolio amongst individual investors so that we can achieve optimal risk-adjusted outcomes. And that really is the base foundation of any smooth bonus product. But so easy for us to start thinking about smooth bonus products as this old concept that is a dying industry here in the southern tip of Africa. And I thought I'll just make one or two comments around what I find very, very interesting. And that is, if you allow me to indulge for a moment, most of you will remember the days where the retirement fund space was dominated by defined benefit retirement funds, where effectively you had a membership to a defined benefit company. You worked for that company for 40 years, and after that, the company paid you a pension for the rest of your life. And really at the heart of that were two things. The one is the employer provided the guarantee, and that created all sorts of problems, and was one of the big drivers why we went over to defined contribution funds. But there was one key aspect of defined benefit funds that really served members well, and that was the fact that all the assets were pooled and that the investment risk was smoothed out. And so what I've got on the slide here to show is some research done internationally and various trends internationally where they are starting to relook at this concept of sharing investment risk, but within the construct of our modern defined contribution funds. And so what that idea is all about, and it's called collective defined contribution, is it's the idea of within a defined contribution fund, like most of our members in South Africa and Namibia is currently, you leverage the power of smoothing or the power of the collective. And that allows you to invest significantly still in growth assets, which is what I showed earlier is the source of growth, while managing the volatility in a much more effective way. And so really at the heart of it, and just to show you, it's not just one asset consultant. So the asset consultant I'm showing here is Aon Hewitt. They've done a lot of research on collective defined contribution, various papers I'm showing. Welcome for you to contact me afterwards, and I can share a lot of this with you. But it's not just them. There's a major think tank in the UK that has recently also published some papers and made a comment that I thought was very interesting. And they say that British people should be allowed to save for retirement through collective pensions, just like people in Holland, Denmark, parts of the United States, Canada, and Sweden. And so what I'm trying to highlight here, it's not just us in the southern tip of Africa that does smoothing. It is a very powerful mechanism to manage the volatility in investment markets that is currently being used by some of the best pension systems around the world, in being Holland, Denmark, the United States, Canada, and Sweden. And Britain is also catching on to this. And so they've recently introduced legislation that allows for this collective defined contribution funds. And I think the Royal Mail is one of the first biggest companies that went on to implement it. So now I'm going to get back on track for those of you who are worried that I'm getting completely carried away here. The point I'm trying to make is that there is merit in sharing investment risk and smoothing the outcomes of members. And just to illustrate to you this idea is what I'm showing you on the slide here is basically the replacement ratio of people that retired from 1955 to, on the slide here, around about 2000. And it shows if they follow different investment strategies in a defined contribution fund, but they all save the same percentage of their salary. They saved 15% of their salary for 25 years. And this shows that if you followed that strategy and you invested in pure equities, this is UK data, but there's a similar principles that applies to us. So if you invested purely in equities for 25 years, say 15% of your salary, and you retired in 1955, you would have been able to replace 20% of your salary, which is not great. All right, so hopefully people save more than 15%, hopefully they save more than 25 years, but this just illustrates a point. And then within the space of 5 years, that number went up to over 40%. It basically doubled within the space of 5 years. And then it dropped down to below 10% in the 1970s. And then there was a strong bull market that made it rise all the way to 60%. in the early 2000s. And so what this is telling us is that if you are just invested in growth assets in a defined contribution fund, and you are bearing all the investment risk yourself, like what is currently happening in defined contribution fund, the variability of the outcomes of the same discipline and the same strategy is incredible. So much so that, one, I can understand why defined contribution funds became popular in the late 90s, because look at the fantastic replacement ratios that those funds offered if you were in a growth strategy. But it doesn't leave much confidence if the variability of the outcome is so severe. And now I want to show you the scary part of what happened in the subsequent 10 years. So in the subsequent 10 years, replacement ratios fell from the height of 60% in an equity strategy all the way down to about 15%. And you saw a similar trend in a more balanced approach, which is the red line, a lifestyle type of strategy, or even just in a pure bond strategy. And the question that Aon Hewitt is asking in their consulting papers when they explore defined contribution funds in a more collective nature, is there any way that we can stabilize these outcomes for the benefit of members to drive higher level of confidence in the defined contribution system and therefore hopefully drive better outcomes over the long term as well? And so the real crux of the matter is, if you just share investment risk and you combine the assets of all the members, you smooth out the risk, then you can get to something like the green line here, where you've got a much, much smoother outcome as well. All right, so let me get back to how we then construct portfolios in Old Mutual. And this covers our whole range of smooth bonus portfolios. Most of my talk today will be uncovering and sharing with you the launch of the core growth portfolio. But really what I want to do is I want to just stand still at just the basic building blocks of how we construct portfolios. And so in doing this, we start off on the left-hand side. We want to achieve certain real returns. And we recognize that the only way to achieve those real returns is to have some level of exposure to growth assets, to have some level of exposure to risky asset classes, but have that portfolio as widely diversified as possible so that we can optimally manage risk. But we also recognize that it doesn't stop there. We cannot just do that, because even if you have a well-diversified portfolio, well-diversified balanced funds could also still lose 20% over the global financial crisis in 2008-9, and also around 20% at the worst point in March last year. So what we then do is we employ techniques and mechanisms that are similar to what I just shared in terms of collective defined contribution funds, by smoothing those investment returns firstly, and then secondly providing fixed percentage guarantees to give members ultimate comfort. And so another way of looking at it basically is to say that in addition to normal risk management, which is diversification, which is what normal balanced funds typically do, we then add another layer of risk management that comes at a very low cost to members, which is smoothing the returns. And then finally, we add the final layer of risk management, which is fixed percentage guarantees. And in particular, the core growth portfolio that I'll be talking about today has got very high levels of guarantees attached to it as well. And another way of just explaining any smooth bonus fund structure is you really look at it as those three components. We start off with a typical balanced fund, and that typical balanced fund delivers returns over the long term that you can see in the pink line. We then smooth those returns, and in the old days it was just a discretionary approach, but more modernly, and I'll share with you, there's a smoothing formula that comes in. But very importantly, what I want to highlight here is that smoothing in itself does not provide a guarantee. And you can clearly see that in what happened last year, is where we had on our more aggressive absolute growth portfolio, we had a negative bonus come through, because there's a limit to how far you can allow the pink line and the green line to deviate from one another. And so smoothing in itself does not necessarily mean there will be no negative returns. But then we add a third component, which is guarantees. And you can add that guarantee as either 50% or 80%, or what I'm going to be sharing today, a fixed 90% or even 100% guarantee. And if you use the 100% guarantee, then of course what you see there in the green line at the end, that can't happen. But I'm very happy to address some of the issues around the negative return and why that was necessary a bit later. But really what I'm showing you here is the fund that you are most familiar with in Namibia, which is the Absolute Growth portfolio. And the question that we are often asked is, well, is there really a benefit in the guarantee? What is the guarantee for? And the easiest way to respond to that is, as Tashi has mentioned, people don't value guarantees until they need it. And in South Africa, but I think to a large extent in Namibia as well, we've been really fortunate in the sense that all the market crashes, the 5 market crashes that Tashi has referred to in his opening as well, have been followed by an immediate, quick recovery in the economy. So yes, we saw a crash in 2008, 2009, but within 3 years, the market recovered. Yes, we saw a big crash last year, but within the space of 12 months, the market recovered for somewhat unexplainable reasons. And so in this environment where you see market crashes but a quick recovery, the value of a guarantee is not as apparent. But I want to show you 2 markets, which is very well known to all of us around the world, where this quick recovery did not happen. And so the most often quoted example is the Japanese equity market, where it started crashing in the early 90s. And about 30 years later, the Japanese equity market is still 40% down from its heights in the late 80s, early 90s. Similarly, the Russian economy crashed in 2008, 2009, like the rest of the economies. But where our line and Namibia's line quickly recovered and we continued a growth path, Russia just went sideways. And since the global financial crisis, Russia is still down 62%, more or less. And so it is in markets like these, environments like these, that 80% or 90% or best case scenario, the 100% guarantee that we're going to be offering on core growth today really kicks in. Because all these smooth bonus portfolios remain invested, as I mentioned, in growth assets. They remain invested in equities, but they provide you with that additional guarantee as a mechanism of safety. So I want to quickly talk about the portfolio that you're already familiar with, and that is the Absolute Growth portfolios, which is effectively the current portfolio in Namibia that has got a significant exposure to growth assets. And so what I want to really just highlight here is, while this has been a fantastic portfolio for us, and a portfolio that has been very successful in both South Africa and Namibia, it is not without its concerns. It is not without its criticism. And I need to be very frank today, in the sense that over the very long term, if I can refer back to one of my very first slides, that over a 91-year period, there's no doubt that real returns comes from growth assets. And so if you design an investment portfolio with significant exposure to growth assets, we expect that to do well over the long term and expect that to outperform a more balanced or a more conservative strategy. But, and this is the big but, it doesn't come without its risk. And that long-term return expectation doesn't always materialize over a 3 to 5 year period. And so some investors that have got a shorter time horizon or do not have 20 or 30 or 40 years investment time horizon may prefer a more conservative portfolio that will hopefully be much more likely to avoid the negative bonus we had last year. And so that is the big but attached to the AGP portfolio that we are addressing with the new launch. And so the other things that we learned is that while the growth assets presented risk, there's still significant benefit in diversification, and there's still significant benefit in having alternative asset classes. So we want to retain as much of that as possible. And then finally, we found that smoothing remains a very effective way of reducing volatility, but we can improve on the smoothing formula. And that I'm going to share with you in a moment as well. And then finally, I think one of the big criticisms against AGP is there's this almost conundrum between having very aggressive underlying portfolio that aims to achieve the long-term real returns, but at the same time trying to guarantee 100% of that portfolio. And the consequence of that is a higher capital charge, which is something we recognize. And the question really, when we ask ourselves, when we design core growth, is there not a way that we can change the underlying portfolio so that we can have a more cost-effective 100% guarantee attached to that? So I'm going to jump to the other side, this is the big moment. This is the big reveal, and I'm really happy to present to you the latest, made in Namibia with some help from South Africa, the new Old Mutual core growth portfolio. And so if you just see a blank screen, that may not be very exciting for you. So let me start off by just talking about some of the things that we are doing in the core growth portfolio. And we are starting off with a strategy that is slightly more conservative. And if we zoom in on the underlying portfolio, we find that compared to the AGP portfolio, the core growth portfolio has got slightly more exposure to interest-bearing assets. You'll see there 20% in Namibian interest-bearing assets, and then another 12.5% to cash, and another 7% to offshore interest-bearing assets. So what that allows us to do is to slightly dial down the exposure to risky growth assets from 80% to just over 60%. It does come with a slightly lower real return expectation compared to AGP, and I'll share that in a moment what that means. But effectively, what we are trying to highlight here is that we still retain most of the positive aspects of the AGP portfolio. We still retain the exposure to alternatives, significant equity exposure locally and internationally. But we bring it slightly down from the aggressive nature of the AGP portfolio. And what that allows us to do is to develop a fund that I believe is going to give us a much more cost-effective risk management type of strategy. And so the underlying portfolio is the first component I want to talk about, but the second component is also the core growth portfolio comes with a brand new smoothing formula. And on this slide, you might see a very complicated table, but I want to share with you just how simple this smoothing formula is. So what the smoothing formula firstly does is looks at the left column, and it looks at where is the bonus smoothing reserve at the point when we declare the next monthly bonus in advance. And if that bonus smoothing reserve is between 0 and 5%, then that means the BSR, the bonus smoothing reserve, is within the long-term target range, where it wants it to be. And then we declare a bonus that is consistent with the long-term return target. So we just take the long-term return target for core growth. It is Namibian inflation plus 4.8%. The target is 3.8 to 4.8, but we take the upper end of that range and we slot it into a formula, and we declare a monthly bonus that is the equivalent of inflation plus 4.8%. That is the gross bonus. We will still deduct the capital charge, but this is just to show the thinking behind that. If the BSR then moves between between 5% and 20%, which is the next range, that tells us that we've got excess BSR. So what we'll do is we'll declare the same bonus that we did in the previous bracket, but we'll take that excess BSR above 5% and we'll spread that over a 24-month period. And that is as simple as how we smooth the investment returns. If the BSR goes above 20%, and this is a brand new feature, we are saying that we want to limit the extent of the BSR so that we allocate returns to members in the most optimal way. And so if the BSR exceeds 20%, clients can expect a special bonus in addition to the normal monthly bonus that I just spoke about, which is the full BSR above 20%. So if the BSR moves to 22%, for example, clients will get an instantaneous 2% positive bonus, and then the monthly bonus that is declared according to that bracket over there. So that really is a very modern way of looking at smoothing in a way to allocate returns to members. Of course, as smoothing works, the BSR can go into negative territory as well. So if the BSR is anywhere between 0 and negative 7.5%, effectively what we do is we say we've got to put some brakes on this. And so then we just try and declare bonuses in line with inflation. We have to cap that for inflation range between 3 and 6%. But effectively what we're saying is in that territory, we're just going to protect your purchasing power and wait for the BSR to recover again. Of course, if that doesn't happen, if we have a severe crash, then you can move into a scenario where the BSR is between -7.5 and -15%. And if that happens, then effectively what we are doing is we are just going to keep bonuses flat. So the 0.15% is really just to cover the cost of the capital charge that we still deduct after this. But really the idea there is to just protect the nominal value of the portfolio. And then finally, this, what I'm going to share with you, is not relevant to the Core Growth 100 portfolio because 100% of it is guaranteed. You can't have any negative bonuses. But in the Core Growth 90 portfolio, of course, there could be negative bonuses. And those negative bonuses, in the past, it was not always clear when it's going to happen and what triggers that. And now we are being very clear in that if the BSR of the Core Growth portfolio drops below -15, you're going to see a small negative come through to whatever is necessary to bring the BSR back to -15%. And that is a much smoother way of bringing the BSR back into the range for the Core Growth 90 portfolio. Of course, there's also a limit to the extent that we can do negative bonuses, only down to 90% of the previous highest level. And so then the 90% guarantee will kick in as well. So that, in a nutshell, is the new bonus formula. You can explain it in one slide. It makes very logical sense looking at the BSR range and then declaring different bonuses. And then the third and the final portion of the product features that I want to speak about is, of course, the guarantees. I've already alluded to it, but we offer Core Growth with two guarantee options. The one is a 90% guarantee with 10% not guaranteed, and then the flagship Core Growth 100, which offers a 100% guarantee. Now, of course, and I think everyone accepts and understands this, there's a cost to a guarantee, but I'm really happy to share that this cost has been brought down significantly compared to the Absolute Secure Growth portfolio. And so the 100% guarantee option, the capital charge we've brought down to below 2% per annum. In fact, it is at 1.8%. And the 90% guarantee option you get for a capital charge of 0.8% per annum. And this really is a very cost-effective way of offering those guarantees. Cassius will share with you from his days in South Africa managing hedge funds. If you wanted to protect 100% of that kind of portfolio that we have in Core Growth using derivatives, the cost could easily be way higher than that. That's the one thing. And the other thing is the cost moves around the whole time because the cost of those derivative structures can move around the whole time. So this really, I believe, is a very cost-effective way to offer those kind of guarantees. And then finally, if we then need to look at what is the end result, what is the long-term net of capital charge returns that I can expect from this portfolio, it becomes a relatively simple calc. So I've already alluded to it, that the underlying Core Growth portfolio, we want that portfolio to ideally deliver Namibian inflation plus 4.8% per year. We recognize there's no way we can guarantee that. And I want to be very clear, we can't guarantee that. And just to temper expectations, we like to rather start talking about it as a range of 3.8 to 4.8%. But if you then deduct the capital charge of the two guarantee options, then you get to a long-term net return target, so net of capital charge return target of somewhere between 3 and 4% real returns for the 90% guarantee option, and somewhere between 2 and 3% real return target for the 100% guarantee option. And that compares very well relative to the other asset class that gives you a 100% guarantee, which is cash. Cash is hardly expected to outperform inflation over the long term. And the benefit of this is that if equity markets run very hard, there's effectively unlimited upside potential on the Core Growth portfolio because of the fact that we have some exposure to growth assets. And so my final slide for today that I want to speak about and just share with you is the summary of the full range. And if you look at this, then on the slide here, you will see the Core Growth 90 and the Core Growth 100 product I spoke about, but also put next to that the Absolute Growth portfolios, which is still the 50 and the 80% guarantee option. And so if we go through the different components and we compare them, we've got the underlying portfolio of AGP being very aggressive with about 80% exposure to growth assets. And that compares very well to a portfolio that is targeting Namibian real returns of 5 to 6%. We've got the more conservative portfolio, or what I would like to call a balanced portfolio, with about 60% growth assets, which is the core growth portfolios, which targets inflation plus 3.8 to 4.8. Both those have got smoothing. Both those offer fixed percentage guarantees with different levels, and the consequence of that is different levels of capital charges. And then the real beauty is, as you can see there at the bottom, the different real return targets. I must immediately apologize. I see I made a typo there. I thought I would have picked it up. So at the very bottom, the core growth 90 should be 3 to 4% net real return target, and the core growth 100 should be 2 to 3%. But if you just make that change, you will see that we offer then the full spectrum of return expected portfolios, from the most aggressive AGP 50 to the most conservative core growth 100 portfolio. And they all follow a very consistent, very coherent investment strategy with modern smoothing technology and then fixed percentage guarantees. All right, I'm going to finish off with my last slide, and usually this is where people just say thank you, but I'll leave you with this final thought. In the current world we're in, I guess the best wisdom that I can share from Cape Town is keep calm and smooth on. Thank you very much.
Thank you for that presentation, Fred. That was very insightful, and I hope it guided and assisted our audience in understanding the smooth bonus fund range a lot better. If I could ask for Fred to just hold the line for the Q&A after, but right now we would like to show you the official the video for the official launch and the unveiling of the core growth portfolio product.
Thank you, audience, for sticking with us throughout the presentations. I know it's a first day work day and it tends to be busy. We have a few questions for Fred. Fred, the first question we have is who will benefit from this investment product, ideally alluding to our target audience for this product. Fred?
Thank you very much. Yes, so the most obvious person that will benefit from this will be investors with a time horizon that is slightly shorter than the typical retirement time horizon. So if I say typical, I mean when people start investing in their early 20s, they've got 40, 50, 60 years time horizon because they would work until their 60s, and then most often they would just retire and stay invested in a living annuity portfolio or a with profit annuity. So clearly those are what the AGP portfolio is designed for. But as you enter into your 50s and you reach retirement stage, or you come closer to retirement stage and you are concerned about the biggest risk in the economy, that's really where the core growth 90 and core growth 100% portfolio becomes very, very valuable. So the way I like to look at this is that spectrum that I showed you offers a very modern collective defined contribution concept of life staging. So you could start off in your 20s by saving in AGP 50. And as you go into your 40s, you could up your guarantee to AGP 80, because then you want to lock in some of the savings that you've made in the first 20 years of your life, but you still want to have significant growth asset exposure. As you move into your 50s, you could then go into core growth 90 that really locks in more and slightly dials down your exposure to growth assets, which is more aligned to a with profit annuity as well. And really, as you then get about 5 years or closer from retirement, if you then move into a core growth 100 portfolio, think about this. What that means is the savings you've made over the 35 years until that point, you literally can lock that in terms of the money that you can then use to buy a with-profit annuity. And the beauty is the underlying investment strategy of the core growth portfolio is very similar to the underlying investment strategy of a typical with-profit annuity. So you already align your investments for that, you lock in your guarantees, and so if you're 5 years out, you can have 100% of what you've saved already guaranteed in terms of purchasing with-profit annuity. And then as bonuses are declared, you just ratchet up that guarantee and you just keep on locking in those returns. So for me, it is not just about core growth and where does that fit, but it is where does core growth fit and where does that offer most value within the broader range. And if you stitch all of those together, it's really when this proposition becomes very powerful.
The second question we have is basically, why would an investor choose a core growth over a balanced fund?
Oh, good question. But my first thought is, why not? But in more serious note, I think it's very, and this is why I stood still at those underlying components. There's not much difference between the core growth portfolio and a typical balanced fund out there. Both of them are diversified. Both of them give you about 60%, maybe up to 70% exposure to growth assets. And so the long-term return engine of a typical balanced fund and core growth is not very different. Now the issue is, why wouldn't you want to smooth those returns? Why would you not want to share the investment risk? Because smoothing in itself is not really expensive. Why would you not want to share the investment risk so that you can have more consistent outcomes? Why do you want to be in a situation where something as random and as left field as the COVID crisis? I mean, who of us thought when the news came out in January last year of this virus in Wuhan, China, who of us would have thought we would be in the position that we are in today? And who would have thought that markets would have fallen about 20% in March last year? And so the question that I ask myself really is, I'm not saying get out of the balance fund. All right, because over the long term, I agree we want to have exposure to those growth assets to earn those real returns. But core growth compared to a balanced fund basically just adds smoothing in terms of the smoothing mechanism. And then finally, in addition, core growth adds the higher levels of guarantee. So for 0.8% capital charge, you can guarantee 90% of that. And really why that is useful is if ever our economy ends up in a Russia or a Japan, or frankly closer to home, a Nigeria situation, or I don't even want to mention a Zimbabwe situation. So if there's a real structural breakdown in the economy, balanced fund is not going to escape that. And so a core growth 90 portfolio would offer you that guarantee so that the money that you've earned with hard sweat and tears for 30 years over your working life does not just vanish because of factors outside your control. And so that really is, for me, the reasons to invest in this portfolio. You are not investing in a conservative cash-only strategy. You are still invested in growth assets, but you add very effective risk management tools through smoothing and guarantees afterwards.
Perhaps to put you on the spot, so we have another question where one of our audience is asking, we have seen a V-shape recovery in the investment markets, specifically the balanced funds, but the AGP is still lagging. Why is that?
Yes, so the AGP bonus is still lagging. But, and I am afraid I don't have that slide here now, but please share that with the audience afterwards, is that it's so important to recognize that if you compare a smooth bonus fund to a typical balanced fund, over the long term, you want to see similar returns, just allowing for the capital charges. But over the short term, there is bound to be a negative correlation. And what I mean by that is over the very short term, when balanced funds does very well, you should expect your smoothing fund to underperform. But the opposite is true as well. When balanced funds does very poorly, a smooth fund will outperform. And that is precisely how we design it. So it is no surprise to us that if we look at the last 12 months, from 1 April last year till the end of March this year, it is no surprise that the AGP fund underperforms balanced funds, because it is how it's been designed. What is important, though, is to remember two things. The one is, in the 3 months from January to March last year, AGP significantly outperformed those very same balanced funds that they are now underperforming. And so you've got to look at it from both sides of the coin, in the sense that in the first 3 months of last year, balanced funds were down 20%, whereas AGP were positive about 1.5%. And so it is just important to recognize that. But the other very important thing to recognize as well is that when we want to compare the performance of AGP with a balanced fund over the very short term, just to make sure there's nothing broken in the portfolio, it is more relevant to look at the underlying AGP portfolio. And there, this is the slide I referred to, I wish I had it, but the underlying AGP portfolio in Namibia has done fantastically well compared to a typical balanced fund. And that is the reason why we were able to recover the negative BSR position so quickly, and why the BSR is in such a healthy position now to be able to sustain better bonuses going forward. So really the underperformance of AGP relative to a balanced fund over the last 12 months is no surprise. It is in fact exactly what I would expect to see. But that does not mean there's anything wrong with AGP. In fact, the opposite. It is doing exactly what it's been designed to do. It is doing the opposite to a balanced fund over the short term, while still having similar returns over the longer term.
Alluding to the sort of negative returns, I would just like to ask, there's a question that was asked, I think more in a broader sense. Why did Old Mutual declare a negative return in 2020?
Yes, so the big why. Big why. I wish I had a rand for every time I had to answer that question. Why did you do it? And why did competitors not do it? Was it really necessary? Had you known then what you know now, would you still have done it? I mean, those are all million-dollar questions. So let me answer all three of them. The first one is, why did we do it? And the reason is very simply put, because we could have not done it. Let me start off with that. It was within our power in March last year to say we are applying our discretion, we are overriding the formula, because the formula said we must do a minus 15% bonus, by the way. So we already softened the formula by only doing a minus 5% bonus. But we could have gone all the way to say, no, we just override this formula and we do a zero bonus. Had we done that, there would have been only one consequence. And that main consequence would have been that for all the members that then did retire in April last year, they would have been significantly cross-subsidized by the remaining investors in the portfolio. That is the first and most obvious consequence. And for us at Old Mutual, being the leaders in managing smooth bonus portfolios, we strongly believe in maintaining reasonable equity between different generations of policyholders. And so while we love the idea of smoothing and risk sharing, we believe there's a limit to it. And one needs to limit that. And we've set that limit internally for ourselves at minus 15% BSR. So what really, in simple terms, a minus 15% BSR means is that for everybody that retired in April last year, if the BSR was minus 15%, 15% of their benefit payments were effectively cross-subsidized by all the investors that are still in the portfolio today. And had we allowed that BSR to fall further below minus 15, that cross-subsidization would have been simply more, and it would have taken the AGP portfolio longer to recover. Make no mistake, it would have been the easier option for us to do. It would have been a lot easier for us to manage our own reputation. It would have been a lot easier for us from a marketing perspective and from dealing with client questions like this. It would have been the high road or the easy road, so to speak, to take. But we strongly believe that we had to make the hard decision to balance the interests of those that retired versus those that are still invested today and did not retire. And the way you balance those interests is to keep the BSR at a minimum of 15%. And so that really is why we did the -5. The BSR was somewhere between -15 and -20%, and we felt that a small negative bonus finds that optimum balance between members that left in benefit payments versus those that remain invested. Second question, why did we do it and why did competitors not do it? And the answer to that is very simple. The answer to that is the AGP portfolio compared to competitors is significantly more aggressively invested. It's got over 80% exposure to growth assets. We do not apologize for that. We believe it is the right strategy over the very long term. And as I positioned earlier, it is in that end of the spectrum where people still have a very long time horizon. But with that 80% growth exposure comes the unfortunate consequence that when the markets fall, AGP falls more than what competitors typically fell with that were more conservative. And frankly, that's part of the reason why we are introducing the core growth portfolio as well, is that we are recognizing that there's a place in this range of portfolios for a slightly more conservative portfolio that all else being equal, core growth would probably not have declared a negative bonus last year. In fact, core growth in South Africa avoided that negative bonus. So the core growth BSR remained between 10 and -10 and -15%. So the third question, had I known then what I know now, would I still have done it? The answer is yes, because even knowing now that the market recovered so quickly, the 5% negative bonus still was the right thing to do in terms of finding equity between all our customers in the portfolio during that crisis last year.
So still, while we're still in the broader sense, there is a question in terms of are both capital and returns guaranteed? This perhaps alludes to the fact that sometimes, because of the way our products are structured, when we say a targeted return, it's perhaps interpreted as a guaranteed return, if I put it that way. Yeah. So could you perhaps just talk to that a bit?
Yes, I'm glad. Sorry, there's a bit of a lag in the line. It's like the old days when we phone internationally with the landlines. I hope you can hear me clearly. That is a very good question. I think I alluded to it briefly, but I want to be very, very clear. We cannot guarantee future bonuses. Although we design the product and our long-term experience gives us a reasonable expectation of what we expect the portfolio to deliver over the long term, there's no way that we can guarantee inflation plus 3 to 4%, for argument's sake. The best we can do is target that and then design a bonus smoothing formula that targets that. But it is dependent on the underlying portfolio delivering that. So the real return targets are not guaranteed. What is guaranteed, however, is what is already been declared, and fixed percentages of your total portfolio is guaranteed. So our competitors and the typical older way of doing smooth bonus portfolios to say, I guarantee your capital, and then I declare bonuses that are split between vested and non-vested bonuses. And that really is not a great product in the sense that it doesn't give customers a clear understanding of what is guaranteed. And so a fixed percentage guarantee of 90% means that if you give me 100 Rand and I declare bonuses of 10 Rand over a period, then 110 is my total portfolio, of which 90% of that is guaranteed. So 9 Rand of the 10 Rand that I've declared as a bonus is also guaranteed. So the guarantee ratchets up. It locks in every month as a bonus is declared, so that once the bonus is declared, then a fixed percentage of that is also guaranteed and can never be taken away. But we cannot guarantee the size of future bonuses.
Thank you so much. Still in the broader sense, looking at the market, how does the AGP and CGP pair up against the competitors in the market, other smooth bonus funds in the Namibian and South African market, perhaps? Fred, did you hear my
Yes,
question?
sorry, just broke up a bit. You were asking?
Technology. Should I ask a bit again? So how
If I heard you correctly, you asked the comment around competitors.
Yes.
Okay, great. So I must be immediately honest to say that I don't operate in the Namibian market in the sense of, I fondly remember the days when Mr. Kannemeyer hosted me there, and I would visit Namibia and we would do road shows and spend time in coffee shops or in client boardrooms. But with the pandemic and the last few years, I haven't been doing that. So I really miss the hospitality of Namibia, but also the biltong. So I must immediately be clear in that I'm not in your market and in your industry to be the thought leader on the detail of the competitor portfolios, but I'll share a few comments. And that is that in South Africa, and to a large extent what we're doing in Namibia and launching today in Namibia is just, a version of what we are also currently doing in South Africa, is we are really the market leaders in the sense that we were the first ones to come to the market with a formula-driven bonus philosophy. We were the first ones to come to market with a fixed percentage guarantee in the AGP 50 and 80 option, or in the core growth options in the late 90s. And so we lead the market when it comes to innovation, but also I think we lead the market when it comes to size and experience. And in that respect, you can rest assured that you are invested with a company that have been managing smooth bonus portfolios for about 50 years. So the Guaranteed Fund, which is our flagship portfolio that we launched, was launched back in 1967. And so over 50 years, we've gained the type of experience that really comes to the fore during a crisis like last year. In March 2020, we had to sit virtually in meetings and discuss these very thorny issues between equity, between different generations of policyholders, between balancing our desire for maintaining our reputation versus doing what's right for customers. And so I guess the most important thing is to say that product features can be copied easily, experience and culture not that easily. And so I think, yes, we can talk about product features and how our product is different to competitors, but at the end of the day, what I'm more proud of is the fact that we have a very long track record in managing these portfolios, and we've got the right culture to do what is right and what is necessary for customers.
Thank you so much, Fred. That was very insightful. We have no further questions for you. Thank you so much for your time and taking time to answer the questions. They're very difficult questions that were basically asked by our audience. We will then come over to the studio to ask Mr. Isaac Vaye, our expert in-house, about the core growth product. So we had a few questions that were posed by our audience online. The first question was, in terms of the product itself, where is the product available? When can customers start investing in this product?
Thank you for that good question. So for our institutional investors, we are ready to do business. We are officially open, and that means to pension provident funds. That is an available option now for our institutional investors. However, for our retail investors, we should be opening on the platforms within Mutual. That will be Max Investment and the wealth platforms perhaps in Q3 of this year, and we will be operating as such going forward. So officially, we are open for business for institutional business as we speak as of today.
All right. Thank you so much for that. The second question was in terms of the portfolio itself. Obviously, you're talking to institutional investors, and institutional investors technically have to comply with Reg 15 or Reg 13 rather, of the country. So how is this product structured? Is it Reg 13 compliant?
So this is a long-term insurance product. So it actually will fall under Regulation 15. So we are at fund level. We are compliant. And obviously, as we said, from the strategic asset allocation given, it does fluctuate, but it obviously fluctuates within the regulatory levels that are given to us.
All right, thank you. One last question. A customer was particularly interested in the 100% guarantee, which means you don't lose anything. Worst case scenario, even if the world goes up in flames today. How do the fees for the both, because we have an absolute growth portfolio with 100% guarantee and a core growth portfolio of 100% guarantee. How do the two compare in terms of fees?
So effectively, the fees of the core growth portfolio are going to be a lot lower. The capital charge on our AGP 100 was currently at 2.8%, 2.7%, correction, thank you very much. And the core growth portfolio will come down to 1.8%. So there's quite a significant difference in that capital charge, and that's also mainly due to also the asset allocation given to the two underlying portfolios.
Thank you so much. I think that was all the questions our audience had posted for us. Thank you for those questions. Very tough questions to answer, some of them. We will now hand over to Ms. Patty Olivier for the closing remarks.
Thank you.
Thank you.
Ladies and gentlemen, thank you very much for spending 2 hours of your time with us. We hope you have enjoyed it with us, and that Isaac and Paul and Justina and Fabio are ready to chat to you should you require any more information from them. Let me just quickly leave you with the thought that humans are created to have certainty in their mind. Whatever we do, we always try to come back to our default of getting certainty. That is why people look at the weather for tomorrow to see what they need to wear. They go to the stars to see what their future holds. And it's all because of that inherent nature of us to want certainty. And as our economist has said, as Fred has said, there's so much uncertainty in the world. And as Tashius has said, our CEO, the last 20 years, it's 5 different things happened that caused so much uncertainty in our world. So we don't know what the future holds, but we can certainly, as Old Mutual, take your hand and we can walk the path and remove some uncertainty in terms of your retirement funding to make sure that you have good retirement when you leave your work life. With that, I leave you. Thank you very much to Fred van der Vyver, who has had a very difficult task in providing core growth to us and launching it for us. Thank you to Roland, who has done the economic overview. And then last but not least, our Group CEO, Tashius, for the wonderful remarks that you've given us. We really appreciate that. Oh, but not last, our Directors of Ceremonies, although they've just recently joined, you've done a sterling job. Thank you very much. And then, of course, the background, Justina and Fabo have been holding the fort for us. Thank you very much for doing that until the 2 gentlemen joined us in the sales department. And then the marketing department, thank you so much for putting it all together. Please take care. We're in a very difficult situation. Please sanitize. Please keep social distancing and let us be safe. So until we meet you on getting the investment proposal to you, please keep safe. Thank you very much and goodbye.
George.